Qualcomm stock price just surged over 13% after the company announced its bold entry into the AI data chip center market, aiming to take on names like Nvidia and AMD. But with AI hype and talk of a possible AI bubble, the question is Qualcomm still a buy or is the stock already priced for perfection? Let's get into it. Welcome to another video. My name is Robin, and as per usual, I'm joined by Kirill. And today we thought it would be interesting to jump into Qualcomm. They have been shooting up today specifically, so yeah, we thought let's tackle it. Let's also talk a bit about the AI hype that people have been suggesting that it's happening, or at least the hype is happening. But the bubble, we also made a video about that previously. So if you want, you can click the banner up here to see that video as well. But yeah, as you guys are already used from us, we have three segments. We have what's in the news. We go over the company fundamentals and also the important ratios. And finally, the value that you're going to get out of this video is the valuation of Qualcomm. But as per usual, guys, do your own due diligence. This video should only be the starting point of your own due diligence. Make sure that you read everything, that you understand the company. And none of this any financial advice, only for entertainment purposes only. Kirill, take it away.
Yeah, that's pretty entertaining, I would say. Yes, yes, all sorts of fun. Yeah, AI bubble is here, isn't it? So 12% up on Qualcomm. Guess why? They just say, oh, you know what? We're just making AI data center chips and we're gonna fight Nvidia and AMD. And we're gonna release V2 in 2026 and then 27. So the new products are called AI 200 and AI 250. And I mean, they just decided to reinvent, a graphics processor. That's about it. But just because of the hype, the stock just shot 12%, a little bit more than that, as at this very moment when we're recording it, which is, to be honest, a little bit crazy and outrageous. And when people say a bubble is in there, it is kind of there. Because before we jump to Qualcomm, maybe I just wanted to show you guys one small interesting graph of how the all different investments happen within the AI industries, and how each of the companies, as you can see here, they are just literally reinvesting into each and every one of them. So you can see all the arrows pointing to OpenAI, Microsoft, AMD, Nvidia, Oracle as well, and some other smaller ones. So basically what it means is that all of these different companies, they claim that they would be investing in one another in return of requesting to purchase their hardware for the AI purposes. So pretty much OpenAI gets investment from Nvidia, but in return Nvidia kindly asks it to buy a lot of chips from Nvidia, and then also is happening to AMD. So to be honest, if this is not a bubble, I have no idea what is. And I have been on the market for a few years. I've seen different things. I haven't been there in 2008, of course. I was quite small kid playing football, probably out there in the dirt. But this definitely looks like a bubble to me, honestly.
Yeah, and it's also not per se a bad thing, right? I mean, we have been looking into so many companies, and a market correction is also welcomed at this point. But yeah, there is, for example, this interview with Jeff Bezos that goes over that it doesn't mean that if a bubble bursts, for example, with the .com bubble, that everything goes away. It's also, you need to get rid of the waste, let's say. And especially with AI, it's also difficult to see the potential when it comes to revenue-wise, to profit-wise. So I think it's good at one point for everyone to understand what's going on. Maybe the prices drop dramatically. Maybe it's going to be worse than the .com bubble. Maybe it's not going to be as bad as the .com bubble. We don't know. But yeah, with the amount of cash flow going in and the absurd valuations that we have been seeing lately, yeah, there might be something, but also, it can also just not happen. There's so much money in the market. There's so many assets. Like, for example, rich people, they don't have anywhere to put assets, so they just dump it in the stock market. So yeah, who knows what's happening. The context of this time frame is way different than it was in, for example, 2003 or 2008.
Yeah, that's true.
So, but yeah, we don't know. You cannot predict these things.
Yeah,
But yeah,
yeah. So that's why at least what we can do when we are saying like, okay, that if it's a bubble or not, we just can do this valuation of stocks that are related to it, right? And so far, as Robin mentioned before, we had a video where the valuations already were crazy. If I recall correctly, that was a half a year ago. So I think checking out Qualcomm is one of the actually best examples of checking what's happening right now in the market. So yeah, shall we get
yeah,
to it? Shall we get to
yeah.
the
Let's
hot
get to it.
stuff?
So the next segment, of course, let's go over the company fundamentals. Open up Qualcomm and let's see what we have. So we start with a good score though, the 930 score of a B. So let's see what juicy stuff you have inside. So we have good operating margins. So that's looking nice. Stock price change, obviously.
Yeah.
Gross margins nice. Net income growth, great.
Yeah, it's not doing so well, let's say on the growth part of things, but it kind of makes sense because it's quite a mature company in a way as well. And of course, then on the PE ratio, it's actually doing pretty well as well. Surprisingly, in comparison to the rest of the market, I would kind of agree to that because it had the highs of 205 US dollars as of May 2024, and it's trying to probably crawl to that point back again. And then again, it's all fully justified by the PE of 15. It's probably gonna change now with the skyrocketing of the stock price as of today. But even then, 15 PE is you don't see that often, especially in the tech industry in all of these semiconductors.
Yeah, do you want to know what the PE ratio is for AMD at the moment?
I'm afraid. Is it three numbers? Or
yes.
Is it, oh my lord, yeah.
252, and Nvidia is 186. So if you compare it to that, I mean, they are not competing on the same industry, right? So Qualcomm is more communication style of thingies, whereas AMD and Nvidia are also high on graphics card, for example, and other computer components. So they are competing on different markets here, and AMD and Nvidia also have the luck, let's say, that they're also involved in the Bitcoin mining and stuff like that. So there's a lot of demand for their products, and of course now with Qualcomm coming in on AI fronts, it might be interesting to take that 15 PE at this point. But Kirill, just let's we'll go over the valuation, of course, in a bit, and then we'll see whether or not that makes any sense. But when we look at the company valuations, and also just make sure that this is based on all information, all data we have, we are tackling and addressing these kind of issues. But for now, we see average revenue growth on all years that we have, which is quite impressive. That double digits, 11%, 12% growth average.
And so you can kind of also see the pattern, which is still growing even after the COVID times. Of course, it rebounded from 2022. It decreased a little bit, but now it's still it's coming back. Actually, it almost reached the peak of 2022. It's good, looking good.
And then when we look, for example, net income growth isn't positive here, but we will go over to see if that was at the beginning. They had like a lot of losses, or whether it's recent, which it can also be a signal. But for now, just take this with a grain of salt. They also have been quickly been growing their free cash flow average at 20% per year. They do cover their debt by their free cash flow. That is their long-term debt, so they can pay off any urgent debt if they would want to in one go, and they would still have some pocket change left. The average share buyback is also good, 1.88%, so they're not diluting you, and they're also growing their dividend at a rapid rate, so that's 10.9% dividend growth there. So yeah, just green numbers all the way, nothing else to add. They do a lot to satisfy the shareholder. The only thing that we need to look in further, I think, is the net income growth.
Cannot agree more, indeed. Yeah. So if we go from the perspective of pre-tax income, we could see a little bit inconsistency here. especially in 2018 in this case. So the question here is it's probably related to it could be happening due to many causes. It could be because of just the regular operational expenses, because you can also see the R&D expense also has increased quite much in the past 3-4 years, let's say, from 2021. Could be pretty much many things, but at least the good part is that still the free cash flow part of things is going quite strong. I would say again from the times of 2020. So good to see. Good numbers, and the long-term debt is almost covered by the free cash flow, even as far as 2024 goes. So it's pretty safe when it gets to the debt burden of the company, I would say.
Yeah, great. For the key ratios, it's all in green. So the research and development is slightly below 40, which is nice. It's where they have strong enough modes, probably strong enough long-term contracts to, that they do not really have to invest that heavily into research and development, although we have seen companies putting in lesser money than this. But given the context in the industry that they're in, it's quite nice. What else do we see here?
And maybe also just to quickly jump on that one, is you can really see the proof of that within, for example, even the mobile chip manufacturing game. So probably more than half of the cell phones have the Qualcomm chips on them, and you probably know from all of these top-notch ones, the Qualcomm Snapdragon ones, they're really there in the top-notch. Samsung phones, OnePlus, like the majority of Android phones, I would say, unless they're really coming from China. So fully agree with Robin on this one.
Yeah, and then we can also, for example, see that the net earnings ratio has been also quite positive in the last few years. 20% is where we like to see the net earnings ratio as well. So that's very much positive. Let's see what else we have. So they have been slowing down on the dividend growth, which is also not per se a bad thing, right? If they want to invest that money wisely in improving their own products.
Fully agree. So for example, again, if they prefer to focus on making these AI chips, there's a lot of demand for it, there's a lot of hype about it. Sure, why not just spend money on there where you can just sell them for some crazy premium with some great margins? Yeah, be my guest. Sounds like a great, at least short-term investment, for sure.
Yeah, and also we constantly preach, or at least Kriel does, when it comes to the share outstanding changes, that it also always have to align with company targets, but also whenever it makes sense for the company to buy more of its own shares. And look what happened during COVID, Kriel.
Yeah, I mean, it was, when did COVID started? 2019,
2019.
right? Yeah,
2019,
so then they just did the perfect thing, to be honest. Yeah, please disregard the colors, but yeah, they just realized, okay, our stock is heavily undervalued, let's just buy back the crap out of it, which they did. Great idea, why not? So that probably begs for strong management, strong leadership. Great job there.
And then with the net earnings growth, it's a bit slower, but it's also zoomed in a lot.
It's not stable, I would say. It comes and goes in waves. So this is something that you might be careful about, especially if you would like to get Qualcomm for the longer run. They might not be as stable as some great companies that really provide it as a competitive advantage towards its stock, let's say, for the investors.
All right. Well, let's go down and see what else there is to unpack. Gross margin, 60% plus.
Yeah, they are kind of just drifting a little bit lower and lower over time. So from 2005, gross margin of 71, it went down to 55 over 20 years, more or less. It is kind of understandable. It's still good gross margins, especially for the hardware-based organization company. So it's not that big of a deal. But if the tendency is gonna last for another 20 years like that, then there is probably potentially an issue with the competitiveness of the products that Qualcomm is offering.
And then with the cash conversion, looks pretty much decent, right?
Yeah, that's pretty good. That's pretty good. But then again, you can see differences in the numbers. It spikes up and down, so it's kind of similar to how the net earnings are behaving. Makes sense. So it's a bit of a mixed bag. But for the PE of 15, which it was right before, I think I'm not sure if the PE got updated with the current spike in the price. But even then, it's not going to be, I don't know, 180 or 200 something. Like it's to some other AI companies, let's say. Yeah. So shall we get to the juicy part?
Yes, let's get to the juicy part. Also, I just want to clarify, I made a small mistake. So I told you, Kirill, that the PE for AMD was 200-ish.
Mm-hmm.
It's still three letters, or numbers, I mean. But it's 144, and for Nvidia it's 53. Just so that we can compare. And the latest for Qualcomm is 16.3. So
16.3. Okay. But even then, it's really incomparable. Of course, Qualcomm is just only stepping its toes into the AI hype. Good for them. Wish them all the best. But even then, 50 something. Okay, for Nvidia. But then again, what's the market cap of Nvidia, guys? It's just unbelievable. I think it's the biggest company now in the world, according to market cap. I think, if I recall correctly, it was 4.5 trillion already. Trillion. It's it's unbelievable. Yeah. It is unbelievable.
Yeah.
Anyways, okay, this video is not about Nvidia. It's about Qualcomm, so let's get back to it.
All right. So, here you see the valuation tool. If it's your first time, we'll talk you through it. So for the free cash flow starting point, we always use last year. Unless you want to do something specific, you can change it. Or if it's, for example, it's a negative free cash flow point, sometimes the formulas will get out a bit janky. So this you can use to adjust where you see fit. And that's, of course, also the beauty about our whole platform, that it's super customizable towards your liking. The projection period, Kirill, what would you suggest? I mean, we just talked about the AI bubble. We don't know to what extent Qualcomm will perform. So all these announcements is just based on thin air. We don't know how it's going to perform. We don't know if people actually want their chips, how the chips are going to behave. So this is all speculation. What would you say would be a valid projection period?
I think here it's simple. We can just imagine that this didn't happen. We can just say the company is just doing what it's been doing with the same rates it's been progressing over the past 3-5 years, whatever. So we can see it's from, let's say, 7.5% to 10% growth, more or less, on the revenue and the free cash flow. So I think we can more or less safely say they can have some comparable numbers. But then what I would suggest is, if we want to do a longer projection period, so let's say 10 years or something, I would rather tune down the revenue growth a little bit less. So let's say 6% maybe.
Yeah. So just quickly, I'll just go over this in a second. Don't mind me. I was looking up something.
Okay.
But projection period. So anywhere between 3 and 5 maybe, or 5 years. Yeah, but given also the competitiveness of
we can let's start with 5.
AI.
Yeah, let's start with 5, and we can just put something that is already there. Let's say 8%, and then again we can just check and adjust our assumptions later on if we just to see the ranges, let's say, of what we're talking about.
Exactly. Yeah. So the discount rate, we keep this normally at 10%. Again, if you feel like you need to use another number to discount it, with 11, 12% or 20%, it's all up to you. For the estimated growth rate. So here we see the estimated growth rate has been 7.5% on average over the past 5 years. The free cash flow growth has been growing with 10.35%. And what I was looking up
Mm-hmm.
was how much are the revenues gonna grow according to Qualcomm themselves.
Oh, good idea.
They project a 12% growth for 2025.
Okay, but it's only for next year.
It's only for 2025, yeah.
Yeah, yeah, yeah.
And a 16% earnings per share growth. And if we just look at Yahoo Finance real quick, our buddies, the analysts, who always, for some reason, have really good,
They're
I say it,
really optimistic.
always are on the high side of things.
Yeah. I mean, of course, they're Americans, so they probably have to cheer up their fellow, citizens and fellow companies that are located there.
So if we go, for example, to Yahoo Finance and we go to analysis, we can find out what they are thinking. And it says, so the growth estimates for this year is 16%, and for next year 1.65%. So that is fun,
Yeah.
considering, of course, that there's this huge influx. Of course, they cannot react this quickly to the news and update this thingy, but still, that's quite a drop.
Yeah.
So that's weird. I would say we always, of course, Crew and I are very, very conservative with our assumptions when we do our YouTube videos. So here I would say between 7, 10, 12%. So 10-ish would be more or less fair for 5 years, won't you say?
Yeah, sure. You know what? Let's try, and then we'll see. Yeah, let's try, and then we'll see. Of course. Yeah, sure.
So projected PE ratio, the average has been 15.
Well, I would also say if we put also estimated growth rate on the 10%. Yeah, okay. I think it should not be more than 20. Let's say if we really experience 10% growth on a yearly basis, and the higher side over the past 5 years has been 19. So I think it would be pretty good. I wouldn't mind paying 20p for a 10% growth rate for such a big company. Yeah, not at all.
And then, of course, for the required rate of return, because you're stock picking, you have a bit of a higher risk. So you also need to account for that. You need to be paid. So compared, for example, to an ETF, which will give you between 7 and 10% returns, you have to account for it. So we normally do the required rate of return between 10 and 12%. And the margin of safety, this is all up to you. If you know everything there is to know about Qualcomm, the market, the industry, the world, then you can put this at 0. But Crew, I think for you and I think 30% would be great. We haven't really read up much about Qualcomm prior to this video. And if it's a good, valuation, then Crew and I might just check it out.
Yeah, fully agree.
Let's do 30% and click the analyze button.
Yes, fully agree. And this is what we're getting. From the perspective of target valuation formula, it's a little bit on the higher side. Again, because of the higher, let's say, potential for the growth, because we're putting 10%, rightfully so. But we're talking about somewhere in the range of $116, $117. And if you also want to account for the margin of safety, then you are talking about 80. But this is, I would say, again, super conservative assumption. So if we, for example, try to say, okay, you know what, they're gonna grow 10% in the upcoming 15 years instead. Now we're having a little bit of a different picture. But then again, it's mainly being dragged by the increasing EPS and just the fact that we're putting really generous growth rate to it. So I would say, if you would ask me, Robin, like, at what price would you buy Qualcomm? I would be really looking, if we especially look back at the graph, at the ranges of, let's say, 100 to 130. Because this is also from, if some of you guys are interested in the technical analysis, this is more like a support area, which was on the lower side of things. The higher one, we're really talking about 145, let's say, 150. But if you kind of want to have a good match between the technicals and the fundamentals of the stock, I think you should really look for the range of 130 probably.
I was just doing some quick calculations. If you go down it, because normally the let's say the Warren Buffett rule of thumb formula, the Benjamin Graham formula, are always going to be except for like the discounted cash flow formula, but those two are gonna always bring down the average a lot. And lately, I've also been pretty confident with focusing on the target valuation and the NPV formula. If I would solely look at those two with the previous calculations, Kirill, I'm not sure if you can reset it real quick. So
Yeah, I
put
can just
everything back
put
to
it back
five.
to 5. Yeah, of course.
So let's say if we would do that, it would give you an average of around $170 without accounting for the target buy price.
Yeah, probably. I think it would also be nice just to remove these two and then see how much would it be. But I can also quickly just do some quick maths. If you just keep our lovely viewers a little bit entertained, then I can really do it quickly. And we're talking about $136 per share. So if we take an average of discounted cash flow formula, target valuation, and NPV, we're talking about 136.
Yeah, exactly.
So a little bit higher than the average valuation that is presented on the screen.
So, but that's of course up to the viewer, and that's also the beauty of our whole of our sheet. So you can look at the formulas, look at what they're focusing on, and then you can really check whether or not this might be a good buy for you. Like I said, the Warren Buffett's rule of thumb formula, especially the Benjamin Graham formula. If you have read the book, you know his philosophy. So it really looks at dirt cheap companies basically, and it's almost never the case that it is aligned with the average valuation. So yeah, it's all up to you. If you want, you can go into Valkyrie. Where can they go? They can go to 930.com. There they can check out the free version, which also means that you can get a couple of free valuations. So you can do this whole valuation yourself. If you didn't like what we said, you can just go to Get Started for free. You get a couple of valuations. You don't even need a credit card, nothing. And there you have it. You can just do your thing. And you can also do AMD or Tesla or any other stock and see whether or not you think that the prices are inflated. And if you want something, if you want to buy it, then make sure to do so quickly. We are coming up with a new dashboard web app, just a facelift of the overall experience. And with that also comes an increase in price because we, of course, have to account for that. Sadly, so just lock in your prices now. The longer your subscription will run, the longer you will have the price. And Kriel, with that said, thank you for being here. Thank you for watching, and we'll see you guys in the next video.